Can the Bajaj Allianz Life Future Wealth Gain 4 plan secure your financial future while simultaneously building wealth over time? Let us find out through an in-depth analysis in this video. Hi, welcome to holisticinvestment.in. We help individual investors like you to make the right financial and investment decision to reach your financial goals in a more faster and smarter way. Now, before analyzing this policy, let us first understand what is this about. So this is a non-participating life individual unit-linked regular or limited premium payment plan. Now, some of the key features of this policy are you have the flexibility to choose a high life insurance cover, and you have access to two distinct investment portfolio strategies, and there are loyalty additions awarded every 5 years starting from the 15th policy year. You also have the option to receive death and maturity benefits in installment via the settlement option, and there are choice of various policy terms to suit your individual financial needs, and you also have the ability to reduce regular or limited premiums. So these are some of the key features of this policy. Now let's move on to understanding the benefits available under this policy. So number one is a maturity benefit, which will be the fund value payable on the survival of the policyholder on the maturity date. So once the policy matures, the policyholder will get the fund value as on the date of maturity. Another thing is a death benefit. So the death benefit is something which is given to the nominee or the legal heir in case the policyholder unfortunately passes away during the policy term. So as you can see from the screen that the nominee or the legal heir will either get the prevailing sum assured or regular premium fund value. So out of these two options, whichever is highest in value at the date of death, that will be given as the death benefit. Additionally, they will also be given top up sum assured or top up premium fund value. So out of these two options also, whichever is highest in value at the date of death, that will also be additionally given on top of the already decided death benefit. Another benefit is the loyalty addition. So loyalty addition will be added to the regular premium fund value as a percentage of your average of the daily regular premium fund value during the previous 3 years, including the current year, at the end of every 5 policy years starting from the end of the 15th policy year. Another benefit is the return of your mortality charges. So at the end of the policy term or the end of the 15th policy year, whichever is later, the total amount of your mortality charges deducted in respect of life cover provided throughout the policy term will be added back to the regular premium fund value. So these are all some of the benefits available under this policy. Now let us take a look at the fund options available under this plan. So there are 18 fund options, which are Equity Growth Fund 2, Accelerator Mid Cap Fund 2, Pure Stock Fund 2, Asset Allocation Fund 2, Blue Chip Equity Fund, Bond Fund, Liquid Fund, Flexi Cap Fund, Sustainable Equity Fund, Small Cap Fund, Dynamic Asset Allocation Fund, Individual Short Term Debt Fund, Mid Cap Index Fund, Small Cap Quality Index Fund, Nifty Alpha 50 Index Fund, Nifty 200 Alpha 30 Index Fund, Nifty 200 Momentum 30 Index Fund. So all these funds are categorized based on the number of percentage they have been allocated to either asset class like equity, debt, money market, and also according to the risk profile each fund option possesses. Like it can range from low to very high. And if you want to take a deeper look, you can just pass the screen and read all how much allocation is given to each asset class and what kind of risk profile each fund option has. So out of these fund options, whichever you feel comfortable with, you can go with that. Now let us take a look at the investment strategies available under this plan. There are two unique portfolio strategies. So number one is the investor selectable portfolio strategy, where if you want to allocate your premium based on your personal choice and decision, then you can opt for this investment strategy and choose from among the 18 funds to suit your investment needs. Another strategy is the Wheel of Life portfolio strategy 2. So in this strategy, at the commencement of your policy, the regular or limited premium and the top-up premium, if you had any, would be allocated in the funds mentioned, like or namely Blue Chip Equity Fund, Equity Growth Fund 2, Accelerator Mid Cap Fund 2, Bond Fund and Liquid Fund in the proportion as mentioned in their policy brochure, which you can take a look at for more details. So depending on your outstanding years to maturity, the predetermined proportion will vary. Now let's take a look at the various charges present under this policy. Number one is the premium allocation charge. So this depends on your premium amount, premium paying mode and the policy here. So from the 11th policy here onwards, there is no premium allocation charge, but if there is any charge, then it will depend on the factors I have mentioned before. Another charge is the policy administration charge, where they will charge a percentage of your annualized premium. So this is applicable during and after your premium payment term and will be deducted at each of your monthly policy anniversary. Another charge is the fund management charge, which they deduct for managing your fund. So the charges will vary depending on the risk profile each fund has. So higher the risk profile a fund has, like very high risk if it has, then your charges will also be a little bit high compared to a low risk fund option. So the charges vary from 0.50% to 1.35%. Another charge is the miscellaneous charge, which is a charge of 100 rupees per transaction. And discontinuance and surrender charge is also present in this policy, which will depend on your annual premium amount, and here you choose to discontinue or surrender this policy. But there is no discontinuance or surrender charge from the 5th policy here. So they also deduct mortality charge based on life cover they are providing you, which will be deducted at each monthly anniversary by the cancellation of units. So if you're a female policy holder, then you will be eligible for an age setback of 3 years. Now the thing with these charges is, like many other ULIPs, this policy also imposes various charges that can significantly impact your long-term return. So this highlights a notable difference when compared to other investments in market-linked instruments. Like for example, if you take mutual fund, there is no discontinuance or surrender charge or something like that. So these are all additional charge for investors, which we can consider as a drawback as well. Now let us take a look at the advantages and disadvantages of investing in this policy. So the advantages are, you have the flexibility to switch between investment fund based on your risk appetite through the investor selectable portfolio strategy. You also have the option to transition between the two investment strategy at any policy anniversary. You have the ability to reduce your current regular premium after the first five policy here as well. There is a flexibility to modify the premium payment term and frequency as well. You have the option to make additional contribution with top-up premiums, and there are systematic partial withdrawal which enable periodic fund withdrawal at a chosen percentage or amount. There is facility for partial withdrawal available anytime after the 5th policy here, and you have the choice to receive your maturity or death benefit in installment. So these are all advantages. Now the disadvantages are, there is no liquidity available during the first 5 policy years, and this plan also does not provide you with a loan facility. Additionally, the sum assured is relatively low, and the fund options provided in this policy appear repetitive due to similar asset allocation across the fund options. So these are all some of the drawbacks this policy has, which you need to carefully consider before deciding to invest in it. Now, as we have a basic understanding of this policy, let's calculate the internal rate of return (IRR) of this policy using the benefit illustration provided in the policy brochure to get a better understanding of what the returns we will get in a hand at the end of the day. So for example scenario, let us assume that a 30-year-old male opts for this policy with a policy term of 15 years. He chooses to pay an annual premium of 1 lakh for the entire premium payment term of 15 years with a sum assured of 10 lakhs. So if the premiums are paid throughout the policy term, then the fund value will be accessible at maturity. Here we are going to calculate the maturity value and the returns based on two future assumed rate of return like 4% and 8%, which indicates worst and best case scenario respectively. These are not guaranteed returns and they do not represent the potential range of outcome that you can get from this policy. This is just for example purpose to give you a better idea how this policy can give you returns based on a worst case scenario and best case scenario, because the returns from this policy are not guaranteed and the actual returns will depend on the fund performance, right? So that's why we are taking this approach. So at 4% return in the worst case scenario, the fund value is 17.27 lakhs, which results in an IRR of 1.75% as per the plan's maturity calculator, which if you compare it to savings bank account rate of interest, it can even give you a better return compared to this. So essentially this return is giving you no value. So this is the worst case scenario. For the best case scenario at 8% return, the fund value is 23.96 lakhs, yielding an IRR of 5.66% as per the policy's maturity calculator. So despite a 15-year representing a long-term investment, the returns are underwhelming and do not justify the associated risk, because the 5.66% is not even comparable. Actually, it's lower than a debt instrument like a bank FD can typically offer more return than this. So additionally, the sum assured is low. So if you take a look at this policy, it may not be an ideal option for wealth accumulation. Now, as we know that this policy is not giving us a desirable outcome that we need for the risk we are taking and the long-term investment we are putting into this policy, what we are going to do is we are going to compare the potential return from this policy to other potential returns you can get from other market-linked investments available in the market by taking a alternative approach. So instead of investing in an insurance cum investment policy like this, we are going to separate insurance and investment and invest in it separately. So for example, let us assume that using the same metrics from the previous example, that we take life cover for purpose, we choose a pure term life insurance policy with a 15-year policy term which cost approximately 4,100 rupees annually, leaving an annual surplus of 95,900 rupees for investment. This surplus can be directed towards options aligned with your risk appetite. So if you're a low risk investor, then you can opt for investing in a debt instrument like PPF, which is a government backed security giving you guaranteed returns, and it also has tax benefits. So if you invest in a combination of term insurance plus PPF, then the maturity value will be 26 lakhs with an IRR of 6.61%. So despite being a low risk option, PPF outperforms the 8% scenario of Bajaj Allianz Life Future Wealth Gain 4 plan, which was the best case scenario of the plan. So now let's move on to the high risk option. So if you're an investor who's willing to take a lot of risk, then you can invest in an equity instrument like an ELSS mutual fund, which has a track record of consistently proving that if you choose to invest in it for 7 to 10 years consistently, it can also give you average 12% return or even outperform in certain cases, and it is also a equity linked tax saving tool. So this fund value combined with term insurance generates a fund value of 40.04 lakh at the end of 15 years. So after capital gains tax, the post-tax value is 36.99 lakhs, offering an IRR of 10.64%. So this alternative approach delivers higher returns and greater liquidity. So unlike Bajaj Allianz Life Future Wealth Gain 4 plan, which has limitations in both returns and liquidity, this strategy allows you to access your funds as needed while achieving better financial outcomes. Now, what is the final verdict on our analysis on the Bajaj Allianz Life Future Wealth Gain 4 plan? So, this plan, as you can see from our analysis, it requires premium payments for a limited period of time or throughout the policy term with the fund value accessible at maturity. However, high charges result in suboptimal returns, hindering the effective wealth accumulation process of the policy. And also, if you take a look at market linked investment, they aim to deliver returns that surpass inflation. But the returns from this policy are unremarkable and the sum assured is relatively low, and this policy also has a high agent commission. So consequently, combining life insurance with market linked investments proves to be an inefficient strategy. Hence, investing in this policy for a long term is not worth it for your portfolio. Instead, what you can do is you can choose to invest in a pure term life insurance policy for life cover purpose, which is a more effective solution for life coverage. And also, to achieve your financial goals, you can prioritize building a diversified investment portfolio tailored to your financial objectives.
If you want to read more about this policy, then you can definitely check out the blog post we have posted on our website through the link in the description. And if you want to gain more professional guidance through a professional financial planner, you can choose to book a one-on-one complimentary consultation with one of our professional financial planner through the link in the description. Also, if you want to gain more investment and financial insights through the leading experts in the finance industry, we also conduct regularly free live webinars through which you can register and gain these insights. The link is in the description. Also, if you like this video, definitely hit like and subscribe to YouTube channel so we can come up with more such financially beneficial content for you. Thank you for watching.